Hey guys, today is March the 5th, 2024, and we're back for another lunchtime analysis. Today's stock is SoFi Technologies. I've been holding it for roughly a year now, and I do bank with them. So my opinions might be a little bit biased, but I'm going to try to spit facts today. I think this one day, so it's down 13% today, but I think this fear is a little bit overblown. I'm gonna tell you why. All right, so the major news for today is the senior convertible bonds that SoFi just sold for 862 million. So what are these exactly, and how do they differ from a regular bond? So a regular bond, you get the money, let's say it's like 100 million, and then you pay whatever interest rate and whatever, and then in X amount of years the bond is due. So it's all cash. So what a convertible bond does is that it incorporates a little bit of equity, not capital, equity. It incorporates a little bit of equity into the transaction. And so what the lender, the bank who's lending you the money, is betting is that the stock is going to go up in 5 years. So right now SoFi is trading at what, 750? So they might be betting that SoFi will be worth $13, maybe $15 in 2029. Yeah. So that's like what, 100% increase over 5 years. That's 20% a year, almost double what SPY makes. It's a pretty good deal. So as like a little bonus, they have these convertible stocks. I'm not really sure what the details behind the convertible stocks are, and sorry for using someone else's infographic. I don't really draw this, but basically the bond can convert into shares. Now, what does that mean for us? It means dilution, which everyone's scared of. But if you read that the capped call transactions are expected to generally reduce the dilution of SoFi's common stock upon any conversion of the notes and or offset any potential cash payments. So they convert into stock. We just have to pay the bank. We are a bank. We have to pay the lender stocks. So what does SoFi do? They buy call options on their own stock. I'm not sure what strike, but let's say it's $7. They buy these call options today. And then when the time comes to give them the stock, we exercise these call options, and then we just pay them with that. So that avoids any future dilution. So they are saying that the dilution risk is mitigated or capped. So I think this 13% drop today is a bit overblown, since the dilution risk is mitigated. Now, another thing or takeaway that I've noted, they're using these the proceeds from this bond sale to retire these 12% Series 1 preferred shares. These are kind of like dividends, permanent dividends at 12.5% of the share cost. I'm not really sure the details behind that, but I'm assuming these are more on the expensive end of ways to have debt, more expensive debt. So they're using these convertible bonds in the future, 2029, to pay off debt, expensive debt now. So what's that gonna do to the P&L or the earnings? It's gonna make earnings go up because now they have less interest rate expenses. 12.5% is more expensive than whatever debt we're getting into now. So that's gonna increase earnings per share on the common stock that I own, so which is good. So overall, instead of seeing this as bad news, that this is low-key good news disguised as bad news, there's still some dilution risk, but that risk is partially mitigated or fully mitigated, and in order for that risk to activate, SoFi has to be at a higher price in the future. All in all, I think this 13% drop is unwarranted. And I already got like 1,000 shares this morning at like 7.9. I'm gonna see if you guys sell some more before I back up the truck and load it up, sort of say. But yeah, that's all for today, folks. Thank you for watching.